It's a Friday in August 15th of 2025, and we are on the markets. Who are we? We're Sonoma Wealth Advisors and the brands of Fermata Advisors, Fermata 401k, Fermata Tax. My name is Dano Weir. I'm the marketing director. I'll be joined in moments by our managing principal, Daren Blonski. In today's episode, we are looking at why you might be stuck with $13 burritos, what that even means. Inflation data came in hot this week. And what's the Fed going to do? They're in a little bit of a pickle, especially with their ongoing dispute with the president. Also, speaking of the president, he met today with the president of Russia and how that may have affected oil prices. We'll get into it after this.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, Fermata Tax, and Fermata Insurance. On the markets starts now.
Daren, you now officially have a high schooler. Congratulations. You will be buying her $13 burritos for lunch or giving her money to do so.
You know, Dan, I was actually just thinking when you mentioned that, I feel like at Casa Grande, where we went to high school, they used to have these Taco Bell burritos you could buy, and I swear they were like $1. It was my memory, it was like $2.50 or something crazy like that.
We did have an official Taco Bell in the school.
We did. Okay. I remember that.
Has been removed by the health police. But for somehow we survived with $1.99 bean and cheese burritos. Yes, that was real.
Man, those were so clutch when you're hungry. You could literally scrounge up $2. That and do you remember the cinnamon rolls at Casa Grande?
Yeah. Oh,
dude,
yeah.
I have wanted to recreate that moment of those cinnamon rolls since I graduated, and I have yet to find one as good as those. And I wonder if it was just because I was like starving as a high schooler that made them taste so good, or they were just amazing.
Yeah, it's one of those things where the memory probably conflates with the quality. But yes, I agree. They had cookies too. They had like big chocolate chip cookies that were always undercooked. And so it was like slightly congealed dough. Perfection.
It was probably the fact that I was a wrestler and half of the year I was dieting or on some stupid trying to make weight thing. And so whenever I got to eat a donut, it was like, oh, you know.
Well, that donut is now $9.99. And this week we wanted to focus on inflation because we got new inflation numbers, some CPI, some PPI. And as we like to do with our show, you know, we are professionals. We manage. We are a wealth management firm, but we're also moms and dads and brothers and friends, and we live in the same world you do. And how some of this stuff hits the road, how the rubber hits the road, is that the burrito is $13 at the end of the day. So I found this from Toast, which is a point of sale company, which you likely have interacted with when you've made a purchase. They're the ones who are always asking you to tip 15 to 40%. But they had a write-up that says burrito prices roll up to a median price of $13.37. A great write-up from Toast. So thank you to them. So Daren, we can just see tracking here from 2023, median burrito price, according to their data across their systems. Median price was $12.25, which is already high. And now in July 2025, that has risen all the way up to $13.37. If we look at their 25th and 7th percentile, meaning like what's the range here from some of the cheapest to some of the lowest, you can actually see in the highest percentile, the 75th percentile, burritos are actually $15.77. So that's a whole heck of a lot for, you know, lunch.
Yeah, I was shocked the other day. I went and got a super burrito carne asada for myself and a bean and rice burrito for my daughter and a drink. And it was like I was approaching $40. It's just like, what on earth has happened?
And that's what's been crazy is to hear some of the headlines, and we'll see the change this week. But the headlines prior to this is inflation is coming down. Inflation is coming down. And on this same article, they actually have this is the burrito index. They have burrito prices net changes from February 2024 to July 2025, and the percentage that it's up has been decreasing from as high as 4.6% increase in March 2024 to only a 3% increase in July 2025, which seems like, this is a chart that's going down, except that this is cumulative. So this is it's still going up. So even if we're seeing the amount that's going up, going down, it's still gone up all this way. And the title of this week's episode is We Might Be Stuck with It. So what are some of the economic factors, Daren, that will have led to something as simple as a burrito now being double digits?
Well, I mean, the thing that first off to understand about inflation is everyone experiences inflation differently, right? So burritos might be something I tend to consume a lot of burritos, and my family does, and Mexican food here in California is pretty prominent and something that we buy a lot of. But that's not necessarily true in, say, the South or the Northeast. When I lived in the Northeast, there was far fewer places to go grab a quick burrito, whereas here there's like 10 on every corner. Huh. So we all experience differently when it comes to inflation, and you really have to dig into the numbers to understand why the inflation numbers are driving higher and what's causing them. Interestingly enough, a lot of the preliminary data I've looked at this week, it's not necessarily the tariffs that are driving inflation the way that, it's not inflation that's necessary, it's tariffs driving the inflation we're seeing. If you want to let me share my screen there, Dan. Yep. And so let me show you what we're talking about, right? So what came in this week is something called core PPI and PPI. So core PPI is what the Federal Reserve looks at, they say, to decide whether or not they believe there's inflation. And so the forecasted expected inflation for the month was 0.2, and it came in at 0.9, which was significantly higher than expected. And you can see these blue bars representing what inflation was that month, and versus what was expected, which is these little golden bands. So it came way above expected inflation. But you can also see how often those who are trying to quote unquote predict these type of numbers are wrong. It looks to me like, just about 100% of the time they're wrong. So I don't think it's particularly surprising that it's not where they expected it to be. What was a surprise is that inflation this month was higher than expected. Well, that's problematic for a lot of reasons. One of the great political dramas being played out on the stage right now is Trump and Putin and battling back and forth. Not Putin, Trump and, I have the Trump and Putin meeting that just happened on my brain. I was trying to catch up and see if anything good had come out of that, other than the fact that Trump literally flew a B-2 bomber over Putin's head as soon as he stepped out of the car. I'm not sure what that was signaling, but I think I know. Anyway, so
your kids call that a flex.
That's called a flex. I think I think we can say that is a flex. Literally, if you look at the pictures of this meeting that just happened in Alaska, I guess we'll divert to this topic for a minute. If you look at Putin showing up, Trump literally had all our military might just lined up on the tarmac. I mean, he had all these, $200 million planes and stealth fighters and all kinds of things. And then he flies a B-2 bomber over the guy's head. But interestingly enough, right before we came on, they had canceled the luncheon that they were going to do, and Trump is heading straight back to Washington, D.C. So I don't know what that means, if the talks went well or if they went bad. But that's kind of interesting nonetheless. So going back to inflation. So
Trump and Powell.
Trump and Chair Powell. So Chair Powell was appointed and is a known Democrat. So he's favored by the Democrats. And now the Federal Reserve is supposed to be non-political, which is pretty much BS. But nonetheless, they're supposed to be non-political, and Trump has been putting pressure on Chair Powell, 1, to quit, and 2, to lower the rates, which he's refused to do. Now, that's semi-problematic, because if Chair Powell lowers the rates, that will stimulate the economy. If that stimulates the economy, then that will further push inflation. And Trump is saying, well, you need to lower rates because otherwise things will get worse. And Trump isn't necessarily wrong either. If we look at a lot of the housing data, for example, I looked at some data last night that there's more housing inventory right now than there has been since 2007. It's far cheaper now to rent a house than buy a house. Well, that's gonna hurt the economy, right? Because if you think about our number one consumption engine we have as Americans is our house. Just look around in the room you're in right now. Think of all the garbage in your room. That without that room, you would have nowhere to put it, so you probably wouldn't buy it. And whenever you buy a new house, you think of all the different things that you purchase, from furniture to to stuff you put in your kitchen, stuff you put in your bedrooms, pictures on the wall, all that stuff, that all has an impact on the economy. And if people aren't buying houses, they're not moving around, that's going to naturally take some heat out of the economy. So Trump has been after Powell to lower rates, and Trump saying, no, inflation's gone, inflation's gone, inflation's gone. And we get this really ugly print that comes out that you saw right here. It says, no, actually, month over month inflation is almost as high as it was way back in 2021 and 2022, when we were all complaining about inflation. So that's not a good print at all. And that puts Trump in kind of a predicament, and it puts Powell in a predicament, because Trump now can't say, oh, inflation's dead. And Powell can't say, well, I can just lower rates. So now we're kind of wondering, well, what's the likelihood that rates are going to get lowered? So this here is the FOMC kind of.
Let me go back to 1 second here, just to clarify that point you just made, because the presumption is that inflation and the interest rates are correlated such that if they leave the rate high, it'll cause inflation to be low. And if they lower the rate, it will make inflation be high. But it's actually the opposite of what you would expect, which is that the rates are currently high, and also for some reason inflation now is high.
Well,
which eliminates their lever to lower rates.
Correct. But the issue is that there's the issue at hand, though, is that it's not, if you push this button and pull this lever, then X, Y, and Z. And the problem is it's far more complex than that. So while yes, in theory, if rates are high, then that would slow the economy, which we certainly are seeing in the housing market. It's not necessarily if they just all of a sudden lower rates, that the economy is just going to tear off either, because there's this thing called stagflation, right? Where you don't have growth, but you have high inflation. And the Federal Reserve is really in a precarious spot because we risk falling into stagflation at this point. I presumed that we would have fallen into stagflation many, many months ago when we started inverting that yield curve. So if the Fed lowers the rates and inflation goes up, and that might stimulate growth, but if it doesn't stimulate growth, then you really have an issue. But if rates are high and growth is slow, then that could be an issue too. So there's not really a good solution at the moment. The best solution could be that we continue to get inflation out of the system. The argument is that the tariffs, though, are creating the inflation in the economy, and that's somewhat still debatable. Does that make sense?
Yeah, totally makes sense. Sorry.
So with that in mind, let's take a look at the S&P 500. So what's happening in the stock market? When we look at the stock market and we look at the heat map, so I show this each week, and this shows you the relative size of each of the various stocks in the S&P 500, which is the largest US-based stocks. You can see Microsoft, Nvidia, Apple, Amazon, Google, Meta, and Tesla are much larger than anything else. Although I'm kind of eyeing Walmart. Walmart seems to be growing as of late, which is interesting. It says a lot, I think, about the consumer. We'll dig into that in a minute. But so what's driven this market higher, Microsoft, Nvidia, Apple, Amazon, Google, Meta, that push higher has really come from these big stocks. So if these big stocks start selling off, that becomes much more problematic for the index. Well, you saw them sell off because generally this is a pretty positive market today. Except you can see down like in your financials, insurance and stuff that are impacted by rates. I think these stocks are now getting, well, wait a sec, maybe we aren't going to be lowering rates, and that's impacting financials. Something noteworthy, United Health, which is the largest health group, has just been getting clobbered in the stock market and really started moving up pretty quick because one, the politicians started buying the stock, and that got out to everybody. And then two, Berkshire Hathaway just disclosed a very large position in United Health. United Health, if you don't remember, Dan, is that the CEO was actually executed by that guy in New York City. Remember that?
Yes.
So it's it's had a rough go ever since then. But interesting that stock has really taken off as of recent. So let's go ahead and look at our S&P 500 on the what we call the candlesticks. So what this represents is the price of the S&P 500. The S&P 500 is typically looked at as quote unquote the market. It's much bigger than that, broader than that, but it's a general way of thinking about it. And you can see the S&P 500 actually finished out positive. And you don't hear the media talking about this, but it closed out at an all-time high today, which is pretty bullish. And remember, we started talking about this last week, or maybe 2 weeks ago, Dan, where I started talking about the float higher. And you're seeing that float high, right? It's just floating. And I wouldn't be shocked to see coming into September, this really get traded down. If we look at it on a daily chart, that was the weekly chart. You can see today wasn't great in the market. We kind of hit resistance here. But I'd say for the week, the fact that we closed above 6,400, that's pretty bullish. Now, the stock market's incredibly overbought at this point from all valuation metrics. So then that's when things start to get kind of long in the tooth, as they say. But generally, it's positive. The stock market did really well this week. We look at our 10-year. We talk about inverse relationship between bonds and interest rates. Interest rates going up, well, that's going to impact your bond prices. And so bonds came back down the last couple of days when the interest rates started going back up the last couple of days. And so with inflation being higher, this is the market saying, well, we think that rates might be going higher. We're not necessarily convinced it's going down. However, I would say this line here is really important. And you can see this was support all along the way, and now it's resistance. I'll really want to see what happens next week with some more data coming in to make any determination. Now, keep in mind, economic indicators are extremely noisy, right? So when we look at this core CPI, this is very noisy data, right? It's all over the place. You can be like low inflation to high inflation, and we're looking for smoothing trends, right? So generally you can say in this period of time, there was an inflationary period of time, 21 to 23. And the question is, now are we entering back into another inflationary period of time? When we look back through all the other economic data for the week, though, you're not necessarily seeing this super strong print. Interestingly enough, core CPI, so core CPI is consumer price index. So this is quote unquote what we do when we buy things. Producer price index is what people who create things are and sell things, right? What their inflation is. And so that the theory is that the producers are already seeing some of the inflation from tariffs, and that's somewhat debatable. But unemployment claims don't remain particularly high. So that's not concerning. Retail sales came in slightly lower than expected. But nothing really kind of really concerning. Consumer sentiment's been low for a while. And that can usually tell you how the consumer feels. And you can see we've been trending down since 20 with consumer sentiment. But it's not necessarily in the basement. Kind of picked up a little the last couple months. When we go back to the charts, I wanted to look at oil, because sometimes when we look at oil, oil really is impacted by what's going on between Russia and Ukraine and the US and all that geopolitical nightmare. And oil didn't really signal much of anything, right? Not really a ton of movement today, considering that, so basically I would read this as the chart saying Putin and Trump, it was just a bunch of little boys trying to show their power in front of each other for their meeting today, and nothing was really going to come of it.
His name is Daren Blonski, Vladimir. Daren Blonski. He lives in California. If you need his address.
Someone's going to show up. Oh, careful, Daren. Just take a look at gold real quick. Gold continues just consolidating across. Looks like there's distribution happening, meaning that there's just a lot of buyer sellers hanging out around that area. The longer this goes, the more likely I think it goes down. I could see a real strong test of somewhere around this area in the near future. That would be if some changes with interest rates, some changes with geopolitical risk. Let's look at our mags next. So these are our Magnificent Seven stocks. These are the stocks that have really driven the stock market higher. When we look at the mags, you can see they're kind of just bouncing around up here on the 60, and not a lot of movement there. And that's why you didn't see the market going higher. What we saw was the rest of the market actually doing okay this week. And you can see that from these two big candles, these two green candles. So this is the RSP. It doesn't overweight those bigger companies, the mags. It just says every stock's equal. And if more stocks go up than down, then the index goes up. And the equal weighted index had a really nice week, two really nice days back to back. And then interest rates came in and kind of threw a pie in their face. When we look at NVIDIA, which is, pretty much the driver of a lot of this AI revolution we're going through. And we talked about this last week, how it's taking over portfolios. Nothing really remarkable there either. In fact, I would say that's probably looking like from a chartist standpoint, that's looking like a rounded top. We're looking like we're getting ready to distribute. I think support right is around 170, though. I could see that stock very easily selling into the 170 range based upon that chart and where support is. Let's see. Let me take a look over here and take a look at the MOVE index, which is a measure of volatility on the bond market. And you can see it's been falling, which tells you there's kind of a risk off element going on in the bond markets, which could be signaling that the bond markets think things are actually going to get better geopolitically, which would be great. Silver, let's take a look, was having quite the breakout. It's come back in. Still say that's pretty bullish chart, though, just because the breakup, if we look at it on the weekly, still looks like a bit of a bull flag there.
So this is feeling like this is like the sixth chart in a row you've shown where we're looking either trading sideways or looking bullish. This is, to me, looking exactly like what you've told me, which is an August float high. And you mentioned that earlier. So can you explain that again, what your theory is there?
Yeah, the theory is just this, that there's less participants in the market. So think of it this way, right? If half of the people who trade in the markets and the institutional buyers, which are far more important than any of the others, the institutional buyers, they're not necessarily in the market, right? They're vacationing in the Hamptons, they're doing whatever they're doing. And the market, when there's less volume in it, tends to float higher, right? It's just easier for that to happen. There's more buyers in the market. And if you think of my theory is such that, and it is a theory, that the float higher has got more and more important in the last few years because all the 401k purchasing that's happening, right? So if you think about it, the millions of people across America who buy part of the S&P 500 every single week in their 401ks, and if those people are just buying continually and they don't really care what the price is, that'll float it higher, right? But then when you get the traders that come back in September, they're not so happy because the market's up higher, and magically there's some kind of reason why we all have a temper tantrum in September, and the market comes back in. And you can see this in chart if we go look at you take a look. Let's go weekly. We'll look at the weekly chart. So I guess September. Let's go back and look at right here. You can see September. You can see how the market floated higher and then sold off. Pretty much gave it all back. That was in 2024. Let's look at 2023. I think it's like 70% of the time the market sells down is the statistics in September. You can see here in 2023, market floats higher in August right there. And then boom, September comes in and it floats down until, October, and then takes off into the end of the year. And that's a very typical kind of what you see. You kind of get the doldrums of summer. You get a little bit of a float higher here in August. Boom, it gets hammered down in September and then takes off October going into the end of the year. Well, magically, guess when all the bonuses get paid out on Wall Street? Yeah, exactly. So let's take a look in 23. If we look at 23, you can see, okay, here's September. So here's your August float right here in this area. That week year, it actually went down for 3 times and floated up at the end of August a little bit and then got smashed in the end in September, 3 weeks in a row, and found a bottom. Let's look at 21.
And when you say institutional buyer, Daren, I just want to rephrase, I think, what you just said, which is that, so if you have a job, you're a W-2 employee, you have a 401k, you made your selection, you chose, growth and whatever else, or a target date or whatever it was, somebody else at unnamed company is managing all of that money. You're just putting it in there. And then ultimately at the end of the day, there is a human or humans at a large institution who's managing the 401k, who's really making the trades within that portfolio. And you're saying that those few people have much more power than Joe Blow on Robinhood making a couple of trades.
Correct. Just you think about the amount of money that institutions move versus the consumer, right? It's vastly larger. These are the people that are trading for the big institutions. They're in there literally trading with the institution's money to make money. And they're not going to want to come back in September and like, oh, thanks for floating it higher, guys. Now, it's a little conspiratorial to say that, right? But I think the evidence is pretty clear. You can see again, here's in September. Look what happened in August. It floated higher and sold off in September. Early October takes off into the end of the year. And we call that seasonality, right? There's just a seasonality to the markets. And it's not 100% of the time because there's always things happening. But here again, in 2020, we float higher in August, sells in September, takes off, got a little bit of a dip here in 2020, and then whoop, goes up into the end of the year. That's kind of the typical pattern to expect in the S&P. So, another couple weeks of maybe some positive float higher. You can see the floating higher right here, and then shove it back down. I can easily see this trend line, this blue trend line moving up. You could easily see this movement higher, and then it comes back into this line somewhere around here, corrects into this line, and then goes higher. Just because it correct doesn't mean like the trend is over. It doesn't mean you shouldn't do anything as an investor. It just means like, hey, there's a seasonality to it. And, if I was going to invest millions of dollars in September, maybe I wait till October because probabilities are on my side that the market's going to do better from October to December than it does from September to December. You just don't know, right? You don't know 100% of the time. So that's the seasonality of the markets and where that thought comes from. again, it's never for sure. There's nothing in this game that's 100%. That's what makes it so interesting, is that it's always a changing thing. Let's just look at Dr. Copper. So, man, hold on a sec. Of course, it's going to do that right now. All right. Well, I'll have to do that later. We're not going to adopt Copper right now because I got to fill out a bunch of stuff. It's going to make me do on the TradingView site. But generally,
Daren, you want to do that, and I could talk about the show just for a second?
Yeah, let's do that real quick to see if
So while Daren gets that ready, just wanted to update everybody. If you're just checking into the show for the first time in the last couple of weeks, or it's been a while, or maybe you're brand new, we are Sonoma Wealth Advisors. My name is Dan Weir. Again, hi, I'm the marketing director and erstwhile podcast host. And our firm has several different brands. We always have had several different brands to service the various needs in a holistic fashion of you, our client or prospective client. And so in addition to our private wealth services, we have Sonoma Wealth, which is Sonoma Wealth Advisors. We have 401k services, which we brand as Formata 401k. And now tax planning and tax services with Formata Tax. So all falling under the umbrella of Formata Advisors, which we have always been. But that's our SEC registered entity name. But recently we've added those brands to our show because we want to let people know about everything that we're doing. So I only just take a moment to say that if you're seeing these brands on the show for the first time in a while or ever, we're still exactly who we have always been. Daren has always been in charge of the whole thing, along with Chris. We're just maybe marketing ourselves a little bit better because of a marketing director. So if you're new, checking out On the Markets too, we would love a subscribe if you could, anywhere you're listening, whether it's on Apple Podcasts, Spotify, or YouTube. A subscribe or a like is any kind of interaction really helps the show. So we thank you for that. And Daren, are you able to show back. Dr. Copper now? Yeah. Awesome.
Sorry about that. Why the charting software asked me to deal with that right when it did was kind of funny. But so we're looking at Dr. Copper. So Dr. Copper can be a sign that things economically are not great. And what's interesting when we look at this, you can see back in 31st of July, copper got just smashed. And a lot of that was the tariff stuff that was going on with Trump. So it's been acting a little bit weird, a little bit harder to read as of late. But generally, you can see that copper thinks things look okay, and the trend is upward still. But it is hanging on by a string right now. And the idea is that copper historically has moved first. The whole Green New Deal kind of threw a wrench in that indicator to some degree because it just put such a demand on copper. And the Trump administration's obviously not been pro Green New Deal. And that has kind of, I think, changed the dynamic of this indicator. But the theory is that copper will tend to signal an event before anything else. Because and if you think about it economically, if you're going to buy a bunch of copper and put a bunch of wires in a house, in a building, in anything, that's something that's going to get planned out far in advance. So the copper indicator in Dr. Copper isn't saying anything particularly pernicious is amongst us or coming at this time. But interesting. We look at IWM, another leading indicator on the stock market, this Russell 2000. These are companies that are really sensitive to interest rates. Interestingly enough, they didn't really sell off much with inflation prints. So I think that's noteworthy. They actually did well because if inflation's going high, it's harder for these companies to do well. If you look at the SOX indicator, which is the semiconductor index, which is the front end of that risk curve, that still looks pretty healthy. Maybe we could argue double top forming there, but not quite. IGV, these are like really risky software companies. That's in trouble. So that's interesting. That could be signaling something. You can see because we closed below this all-time high right here this week. You can see that all-time high. I would have liked to seen this go up, trade into that all-time high, then move higher. But the fact that it traded above it and went below it, that's not a very good sign. So that could be a crack in the dam. and that we could look at. High yield junk bonds doing great, and they look really strong, which is usually a sign that things look good economically. The idea is that high yield corporate bonds, meaning these are corporations that have a lot of debt and aren't very healthy, people start dumping these first, and you can see they're not dumping those right now. So that's positive. So I think overall, I think you have to take a positive stance on the market. I think things look fairly healthy right now. Even developed markets, you can see one of the number one performing. And if just a shout out to my buddy Chris, he loves having a well-diversified portfolio through developed, US, and emerging. And emerging and developed have done poor until recently. And this year, they're just crushing it. So it does pay to be diversified. And what tends to happen is then you get these lumps. So developed market's going to be Europe. So with all that's going on in Europe, it's doing pretty handsomely right now. And as is emerging markets, doing very well as well. They lagged the stock market after the 2022 decline, but now they're really making up some steam. So it does pay to be diversified, but you just have to be patient. If we talk about Bitcoin, Bitcoin hit an all-time high, then closed and went down. That's not necessarily bullish. Could be putting in a double top there. You can see that top here and that top here. I would be watching 111,000 really closely. If we break below that, we'll probably go lower. So all interesting, and I think overall, I think we got to be positive and see things is looking pretty good right now. We'll see how things pan out next week, and as always, we'll keep you updated if things change in the meanwhile.
Daren, thank you so much. Thank you for checking out the show. As I said, if you're new, we would love a subscribe. We would love interaction from you if you want to follow the show, and so that way you don't miss future episodes. Also here on the YouTube channel and on Apple Podcasts and Spotify, we have other podcasts to check out, including our podcast, It's All Money, which Daren and I also host. So if you're loving today and you want more of us hanging out, talking about money, check that show out too. SonomaWealth.com to learn more about our firm, and we will see you next week. Thank you so much for checking out today's show, and thank you so much for your time. We really appreciate it. Have a great day and a great weekend.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. Fermata Insurance. Appropriate insurance is an important part of a financial plan. Find out what coverages you may be missing at fermatainsurance.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax, DBA Fermata Insurance. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.